Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of AP Møller MAERSK AS. MAERSK is listed as an over-the-counter pick through their ADRs in the United States under the ticker symbol AMKB. So we're looking at MAERSK today as a subscriber request. The company is a global shipping giant that is currently paying out a 12% dividend yield, so one of the highest dividend yields in the entire stock market. Currently, their ADRs are trading for $2,171. And their stock price is down 38% over the past year. Over 5 years, however, MAERSK is compounding at a rate of 4.5% annually. Over 10 years, the business's stock price is down 73%. They had this massive decline in 2014. And going back prior to the global financial crisis, over the last nearly 17 and a half years, MAERSK is down 75% overall. MAERSK's ADRs are trading about $400 above their 52-week low. They're down nearly $1,700 from their 52-week high. MAERSK has a market cap of about 258 billion Danish krones, which is around 40 billion US dollars. So for additional background about the business, AP Møller MAERSK is a Denmark-listed global conglomerate involved in global trade, shipping, and energy. MAERSK Line, the largest contributor to group earnings and revenues, has been the largest container shipping company globally for more than 20 years. MAERSK was founded in 1904 and has since been run by the Møller MAERSK family, which currently holds slightly more than 50% of the shares in the company. The group has been active over the past few years in divesting non-core operations such as its long-standing stake in Danske Bank and Danske Supermarket, as well as its oil and gas operations. So MAERSK was founded in 1904 and is based in Copenhagen, Denmark. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of MAERSK based off their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. So starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. MAERSK operates in the cyclical and heavily commoditized container shipping industry, so their returns on capital are likely going to fluctuate with freight rates, which since the COVID-19 pandemic have really skyrocketed in recent years. So in 2021, MAERSK earned about 31.5% returns on capital, and over their last 12 months, they're earning about 43% returns on capital. So these are massively above where the company has been at in these previous years. However, even averaged out over these past 5 fiscal years, MAERSK is only earning about a 9% average return on capital, as they were dragged down by these years prior to the COVID-19 pandemic. So while that is slightly better than that of a typical business, that's below that 14% benchmark we're looking for, and so this is an X to start things off on metric number 1 for MAERSK. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, earnings, and free cash flow growth over the last 5 years, and this metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So we'll also be including their last 12 months worth of numbers in our calculations here. So over this time, MAERSK has grown their revenues by more than 2.5 times. Their earnings are up massively after being negative in 2017. They produced about $30 billion worth of earnings over their last 12 months, and their free cash flows are up more than 30 times over this period. They had about $765 million worth of free cash flow in 2017, and over their last 12 months, MAERSK has produced $29 billion worth of free cash flow. Again, operating in a highly cyclical industry, it looks like MAERSK has really ridden the wave of a potential boom cycle in the industry as demand has shot through the roof, and there's a lag time between when supply is able to come online for this business. So this is huge growth over the past 5 years here for MAERSK. It's especially great to see such strong free cash flow growth and the fact that the business was cash flow positive in all 5 of these previous years, because free cash flow is really the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So a business can use its free cash flows to reinvest back into the business, make acquisitions, buy back shares, pay down debt, or pay dividends. Great to see such strong growth here from MAERSK. This is our first check of the day here on metric number 2. So next up for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at MAERSK on a per share basis. So we're looking for earnings per share growth over the past 5 years. The financial data for this metric is going to be off because this is an over-the-counter listing of their ADRs and they're not that heavily traded. So this is not their primary ticker symbol. However, this is still going to be directionally correct. So over the past 5 years, their earnings are up massively, and MAERSK has also bought back 10% of their shares outstanding. You'd have to dig in to understand at exactly what prices these share buybacks were occurring, but they were likely a good sign for long-term shareholders in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business buys back shares, by decreasing the amount of shares that they have outstanding, they're increasing your ownership percentage in the business, which ultimately is going to increase the percentage of the business's profits that you're entitled to. They're doing this without you having to spend a dime, so it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want the company to be getting more value than the price that they're paying. Again, this is off because this isn't the primary ticker symbol for MAERSK, but this is directionally correct, and this is our second check of the day here coming in on metric number 3. Metric number 4, we're looking for something very similar. So here we're looking for free cash flow per share growth over the past 5 years. This metric is also going to be a check for MAERSK for almost the exact same reasons. Their free cash flows are up massively over the past 5 years. Again, these per share metrics are just going to be directionally correct here, but with their strong free cash flow growth and their 10% share buybacks, this is another check for MAERSK on metric number 4. So far through our first 4 metrics, we have 3 checks and only 1 X for MAERSK. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. MAERSK ended 2021 with $3.5 billion worth of net debt. Since then, they've increased this, and right now they have $7.2 billion worth of net debt. However, over the last 5 years, MAERSK has produced nearly $34 billion worth of free cash flow. In 2021 alone, they produced $19 billion worth of free cash flow, and over their last 12 months, MAERSK has produced $29 billion of free cash flow, so they'd be able to pay off their entire net debt position with only 1/4 of their current free cash flow, meaning that the business right now is highly cash flow generative relative to the debt that they're employing in the company. So this is a massive check here on metric number 5. Again, though, you may want to be careful that the business wouldn't add too much debt, as they do operate in a highly cyclical and highly commoditized industry. And if their free cash flows would swing back to where they had been in the past, it could be very difficult for the business to maintain a high debt load. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. So if this is the case, this will give us a slight risk premium to the yield of the 10-year treasury and potentially give us a reasonable starting point for a valuation of MAERSK. We learned that over the last 5 years, the company has earned $34 billion worth of free cash flow, meaning that in an average year, they're producing about $6.8 billion worth of free cash flow. And right now, MAERSK has a $46 billion total enterprise value. We're using their total enterprise value because it takes into account both the business's net debt and their market cap, and it's going to give us a perspective of the business that makes it more similar to as if MAERSK was a private company. So when we divide their $6.8 billion of their average free cash flow by their $46 billion total enterprise value, that gives us about a 14.5% average free cash flow to enterprise value yield for MAERSK. So that looks like that's significantly above that 5% risk premium that we're ideally seeking, meaning that this is a check here on metric number 6 and that MAERSK may be a potentially interesting business to dig in and learn more about. Also worth noting is that over their last 12 months, as we previously learned, the business has produced $29 billion worth of free cash flow. That is going to lead to a pretty huge current free cash flow to enterprise value yield for the business. So when we divide their $29 billion of their last 12 months of free cash flow by their $46 billion total enterprise value, that gives us more than a 60% current free cash flow to enterprise value yield for the business. So it looks like MAERSK is currently trading for less than 2 times its current free cash flows. So that is a very huge yield, although it will depend on how sustainable that yield could be for the company going forward, as because this industry is so cyclical and because they're so commoditized, the global container shipping industry is prone to these boom and bust cycles where they have periods of very high capital investment and then periods of very low capital investment. And these booms and busts really fluctuate, where these businesses can look especially cheap on a number of quantitative factors, during their boom cycles, and they can look especially disgusting and overly priced in some of their bust cycles on these very same metrics. So it's really important that even if you're interested in the business because of these high yields here or because of their recent performance, that you dig in and you do your own homework to understand this business in more depth and to try to understand if you can get some insight into whether these free cash flows are going to continue like this into the future or not. So it's worth mentioning that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And even though this is a big check here on metric number 6, this is only one of our 6 metrics, and this analysis is meant to be taken in holistically. While these metrics are simple, when they're combined together, they can be very powerful. Then as a bonus, here we're looking at MAERSK dividend profile. So right now, MAERSK is paying out a 12% dividend yield, which is massively above that of the yield of an S&P 500 ETF in terms of what they'd be paying out as dividends. So again, this is going to be off because this is not the primary ticker for MAERSK. However, it's still going to give us a directionally correct analysis of the company in terms of whether or not they were able to produce the free cash flows necessary to comfortably support their dividend. So people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business like we're doing here today. So in all 5 of these years, it looks like MAERSK is comfortably able to support their dividend payouts. They had their highest dividend payout ratio in 2017, but since then, their dividend payouts have been pretty well pegged to their free cash flows as the company has been paying down debt also. And then with their recent booms in their free cash flows, it looks like the company has repegged their dividend to their free cash flows. And it looks like they've been paying out about 40% of their free cash flows as dividends or so. So whether or not the absolute dollar value of these dividends is able to be continued to be paid out, that's likely up in the air. And again, they operate in a cyclical industry that looks like it's had quite the boom in recent years, but it does seem to be the case that MAERSK would continue to peg their dividend payouts to their cash flows wherever those may lie. So then in summary, AP Møller's MAERSK checks the box on 5 out of 6 of our metrics. The company does not have predictable enough free cash flows for us to be able to perform a discounted cash flow analysis of the business without that being a total guessing game. So I'm not going to perform that for the business here. However, the company does look strong across a number of our metrics today. It looks like their dividend payouts are reasonably pegged to their free cash flows. Whether or not their current free cash flows are going to be able to be maintained into the future is going to depend on where global freight rates are going to be at into the future. And to have any sort of insight into that is just going to require deeper work into the business. It looks like based off of both their average and their current free cash flows that the business may be offering a potentially attractive risk premium to the yield of the 10-year treasury. Although because of the cyclicality and the commoditized nature of the industry that they operate in, you really need to do the work to understand what kind of qualitative factors that the business has going in its favor to see how the business would fare and compete across both boom and bust cycles in their industry. While the business has added on quite a bit of debt in their most recent year, it does look like it's supported by both their average and their current free cash flows. Then MAERSK has also bought back 10% of their shares outstanding over the last 5 years, and they've experienced massive revenue, earnings, and free cash flow growth as these freight rates have increased globally. While they're earning huge returns on capital over their last 2 years, the business's average returns on capital over their previous 5 fiscal years is only about 9%. So while that is a little bit better than typical, that's below the benchmark we're ideally looking for. Again, even though this business looked potentially attractive across a number of quantitative factors in their financials, there are reasons why this might not be potentially the case, as it's often the case that in these highly cyclical and commoditized businesses, that they look particularly attractive during their boom cycles, and they can look very unattractive during their bust cycles on these metrics. So it's worth being extra cautious here with MAERSK, but if you are able to dig in and learn more about the business and have some sort of insight that either the market is mispricing how long they're going to be able to maintain these free cash flows or what's going to be a more normalized perspective of their free cash flows going forward, then it looks like MAERSK could be offering a potentially attractive risk premium. Although again, that's just going to require deeper individual homework. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about MAERSK. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand what's important and what's not important for the business going forward, ultimately coming to understand its underlying essence. So through deeper research, you'll learn more about the qualitative and the quantitative factors of MAERSK, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for MAERSK will be. So with that said, that's it for today's fundamental stock analysis of AP Møller MAERSK, traded in the United States over the counter under their ADR, ticker symbol AMKB. Again, we looked at the business as a subscriber request, so thank you, Justin, for sending me an email about the company, as I'm happy to make an analysis of the business. MAERSK fits right in with looking at a number of other shipping businesses that we've taken a look at in the past, which some of their other competitors, such as Zim, also look potentially attractive right now as well, although they come with a lot of the same risks and a lot of the same caveats. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about MAERSK with me, and have a great day.